download 160. We're doing it outside today. A couple of reasons. I need some vitamin D, but to actually prove that we do have sunshine. It's great after how many days of rain?
Way too many. And since it started at home, we've had like 185 millimetres. So
I drove out to Bow Desert. Hello to David and Penny on Monday, and that drive out to Bowie was really lush,
yes.
You know, and even compared to say 2 or 3 weeks ago where it was sort of a sandstone colour, it's just been amazing. So bringing it back to shares, it'll be interesting to see if there's a knock-on effect from an agriculture point of view. I know a number of our clients have been really happy, you know, getting harvest done at the moment, but that pre-soil moisture has been really good for them
to plan into. Yeah.
So anyway, Dan, that's our meteorology corner covered for this week.
We're finished.
We're done. Thanks very much. See you next week. So what did you want to cover off on today?
Oh, just nothing really.
Nothing.
No,
fantastic.
Seriously, I've been getting a few queries about whether we're in a bit of a bubble, and I just found a chart
share
the other
market
day.
Valuation bubble. Yep.
That's it. That's why we do, Andrew. Shares. So I just found a graph with some price-earnings ratios pre-GFC.
So for those playing at home, do you want to quickly run through what a PE is? So basically a PE is like a valuation. So if we're having a look at, say, a company has a PE of 10 and its earnings per share, its profit is $1, therefore the price is $10. And basically, the higher that PE number is, the more expensive they are, the cheaper it is, The market average is around 13 to 14 times. So if you're at a company, so say as an example, one that we really like called WiseTech, WTC, the PE on that one is 75 times. I've just told you the average is 13 to 14 times. 75 times, that's probably a bit scary. When everyone was hating Challenger, CGF, that's where its PE at its worst, when everyone was hating it, was 3 times. So
screaming buy, isn't
a screaming buy. So whenever you're looking at a company, one of the things you look at, lots of things to look at, but one of the things you look at is PEs. Anyway, back to you and your PEs.
And just on that, the banks are pretty cheap at the moment, aren't they? They're around a bit under that 13 times. But before the GFC, pre-GFC, Westpac at 15 times, Commonwealth Bank almost 16 times, Wesfarmers up at 20 times, it's now around 16. Woolies at 24 times.
And where is it now?
Woolies about 19.
So really all those numbers you just gave us, it's probably somewhere between 10 and 20% below where it was pre-GFC. So this whole notion of a bubble...
It's not there yet, is it? I don't think.
No. The US is probably closer to being overpriced, or dare I say it, a bubble, but certainly not in Australia. You know, I think that's a bit of a stretch.
Yeah, which is interesting, Andrew, just on those PEs on the banks, reporting period coming up for the banks. ANZ tomorrow, Macquarie on Friday, and then next week National Bank on the 2nd and Westpac on the 6th.
And that's really important because the banks make up 40% of the index, more than 40% of the index. So that's really going to determine how we're going to travel leading into Christmas. But the other thing for our self-funded retirees, 1 in 4 Dornbush clients, self-funded retiree, is that they'll see a treasure trove of dividends coming through probably, mid-December, something like that.
Late December.
So all the grandkids out there, things are looking good for your Christmas presents. Not that there isn't a Santa. There is also a Santa, but Grandma and Granddad kicked the tin as well.
You're in trouble, brother.
I'm in so much trouble. What else is there to talk about? Wesfarmers' result came out this morning for the first quarter. It was okay. Certainly, Officeworks ahead of expectations, so they should have sold that off. Kmart continuing to do well. Target's still a bit of a basket case, but the reason the share price is copping it today down about 4% is because Coles, their same-store growth actually slowed to just 0.4%. So it's still growing, but if you look at where it was this time last year, it was 1.8%. So what's going on is they're having to cut prices to compete with Aldi and also with Woolies. And we've seen, Woolies bounce pretty hard as they've been stealing market share.
Their prices come back too recently, though, hasn't it?
Bit of profit taking.
Yeah. And Coles and Woolworths are really reinventing themselves, though, Andrew, aren't they? So, perhaps this is just a bit of a blip.
Partly that, and like say online delivery as an example. I can't remember where I was last night, 7:30 driving home. There's a Coles delivery van delivering stuff to someone 7:30 at night. And you're right, they are trying to get in front of Amazon, trying to get in front of Costco, all this disruption that's either in play or coming along. Any
New
other
energy
thing?
solar?
New energy solar. So that's a new float that's allegedly coming along. Read the financial review for sort of the background on that one. Yesterday's and today's financial review. We've participated in that one for some clients when it was unlisted. So basically, they own sort of 4 solar farms in the US, and they have clients like Duke Energy and Stanford University. Long-term contracts. Was a pretty attractive yield initially, but as they're sort of getting more scope and scale, it's still okay. It's probably going to be about 4.5–5%. But probably the key appeal is its infrastructure and its long-term. And of course, obviously, referencing again the sun, you know, this clean energy thematic, and there isn't really a lot of exposure to that on the ASX, is there?
No, there's a smaller one, Gen X, but really, no, not much more. The other thing about that too is it'll be an international share, really, with an income stream, so that'll be a little bit different.
So it ticks that US dollar earnings, and if Mr. Trump can get through, you know, these tax cuts, which at this stage he's off to a reasonable start on that, that could really drive the US economy along. And that would also be a positive for new energy solar. So again, have a chat to your friendly Dornbush advisors.
The other thing that was in that email, that I'll shoot that out to my clients, I think, what was it, Propel Funeral Services? And we've seen how well InvoCare's gone. You know, we probably won't get a look at Propel on the float, Andrew, but you know, perhaps in that first week of trading, it could be worth having a look at.
And you're right, InvoCare has been an absolute cracker. $2 up to about 17 over the last 14, 15 years. So again, it's a very predictable, reliable business, with all due respect. So that's certainly one to have a bit of a look at as well. Well,
I reckon that's about it.
I think I'm going to go and have a bit of a wander. I'm enjoying this sunshine. This is great.
No
Till
worries.
next week.
Cheers.